Warren Williams, Smartest Data, Quick Definitions. The yield curve. So what is the yield curve? Why is the yield curve so important for an economy? And how is the pricing of variable and fixed rate mortgages impacted by the yield curve? Let's go to the video, define and explain the yield curve, and at the end of the video there'll be 3 quick bullet points to take away. The yield curve graphs the government bonds' annualised yield to maturity plotted on the y-axis. On the x-axis is the term to maturity for these bonds issued by the same issuer under the same credit rating. To understand the yield curve, understand that the x-axis, horizontal, plots maturity and the y-axis, vertical, plots yield. Or more accurately, the annualised yield to maturity, which changes and brings the different shapes to the yield curve, normal, flat and inverted. The graph sloping up from left to right is the normal yield curve and is representing the normal term structure of interest rates. The yield curve plots bonds issued by the same issuer, for example the US government, under its credit rating. The range of maturities plotted on the x-axis extends from short-term, under 2 years, then 2-year, to 10 to 30-year long-term bonds. The different yields are plotted on the y-axis and the yields are constantly changing, driven by market forces. A domestic yield curve provides a benchmark rate for all other debt instruments in the economy. Thus, in the US, the yield curve for the US Treasuries will guide the pricing for all other debt securities or offerings such as mortgage bonds, corporate bonds, variable rate mortgages and bank loans. The yield curve will be used to forecast changes in the economic cycle, from growth to peak to slowdown to recession. The pricing of home loans is also determined by the yield curve, thus becomes an instrument to implement monetary policy, as mortgage repayments are a major outflow of the household budget. Short-term rates will be raised or lowered by the central bank. Variable mortgage rates are priced at the short end of the yield curve. Fixed-rate mortgages are priced from the mid to the long end of the yield curve, as mortgage bonds are issued to match the term of the fixed loan mortgage. So to put this into perspective, the quantitative easing programs QE and QE2 implemented by the central banks impacted the long end of the yield curve, lowering the price of fixed mortgages. The property market is driven more by people's ability to service a loan rather than the price of a house. But we all think in terms of house prices, thus QE and QE2 were major factors in driving house prices. The most frequently plotted debt maturities on the x-axis of the yield curve are 3-month, 2-year, 5-year, 10-year and 30-year. 3 takeaway bullet points regarding the yield curve. It is a graphical representation of the term structure of interest rates. Plots the annualised yield to maturity against maturity, y-axis yield, x-axis maturity. Provides a benchmark rate for the issuing of debt instruments in the economy, such as mortgage bonds, corporate bonds, variable rate mortgages and bank loans.